Auto major Maruti Suzuki did come out with a steady state this time around, though there has been a bit of a margin miss, but that's on the back of the new plant commissioning done by the company. But what's the growth part that the company has set for itself? Let's take this discussion forward with Maruti Suzuki Chairman, Mr. R.C. Bhargava. Mr. Bhargava, so good to have you on ET Now, and thank you so much for your time. I would like to begin to know your outlook on the industry growth per se, because with the domestic projections, they are just at a modest 1 to 2% only. Do you believe that the recent policy moves like the tax relief and the easing interest rate environment, this can actually provide a meaningful boost to the demand, particularly for the small car segment?
Certainly, the income tax relief and the lowering of interest rates will be positive factors. But I'm afraid that the gap between the cost of a small car and what the customer can afford, and I'm talking of people who are basically upgrading from a scooter, that gap is such a big gap that it may not have too much of an impact to revive the car market. I think more needs to be done to reduce the cost of the small car, especially for the entry-level customers, by re-looking at the GST rates for these products.
Right, but Mr. Bhargava, when I see your numbers for the quarter gone by, your margin seems to be taking a bit of a hit. We understand that's partly due to the new facility and the elevated other expenses. But should one see this as a one-off, or because of the new facility the depreciation impact of the new plant can be there for some more time? And if I can add to that, can we expect you to see returning to that 12% range from Q1 onwards?
You know, despite the new plants, we can return to higher margins if there are favorable exchange rates and favorable commodity prices. The margins are not entirely dependent on what Maruti does. External factors also play a role, and therefore predicting and maintaining any level of margin is really not a very meaningful effort on the part of any company. You have to do what you can to control the expenses on the areas which are within your control. And the areas where we are going to work on particularly is to reduce the cost of marketing and selling cars, particularly in terms of discounts and promotions. We think that if we manage dealer inventory better, use retail sales as the criteria, prevent large stock accumulations with the dealer, we can reduce these margins and promotion costs, and that will be one factor which will work positively. If the sale numbers can go up because of the factors we just discussed, the income tax and the financing costs coming down, that will be another factor. The higher the demand is, the lesser is the need for promotions and sales things. So my view is that let's see how the things develop, what happens in these areas, what happens to foreign exchange rates, what happens to commodity prices. Is there a global slowing down of the economy, or will the economy move faster than what people are predicting? And these are all things we don't know at the moment.
All right, but Mr. Bhargava, despite the tailwinds that we just touched upon with respect to the domestic markets, it's the export and the overseas market where you are targeting big. I believe that 20% jump on a YY basis is what you are targeting for. But given the global uncertainty, what actually gives you the confidence of achieving that? And along with that, which geographies are you willing to target?
You know, I don't think Mr. Trump's tariffs are going to affect the market we are dealing with. We are exporting cars. Japan, for example, has become from this year a big area of exports for us. It's not going to get affected by Mr. Trump's tariffs at all. And we are exporting to many parts of the world. You know, some of them is in South America, it's in South Africa. So those exports are going to continue. They're not going to get affected. And our estimate of this year's exports are based on an actual assessment carried out by our people on what the market looks like. Okay, this was done a little bit before all the global events happened recently. But so far, at least, there's nothing to indicate that anything negative is going to happen.
All right, that's so good to hear. But Mr. Bhargava, just wanted to touch upon the mix of the industry, because when we see the surge in the utility vehicles, they now account for nearly like 70% of the industry volumes. Do you see this share plateauing or even declining going ahead? Because is there a risk in the over-reliance on the UVs within the broader passenger vehicle segment? Because every car can't be just UVs.
See, what is happening is that this segment, which is today growing, is a segment in which the buyers are households with incomes, by and large, not entirely, by and large, of incomes above 12 lakhs a year, households. But that number of households is only 12% of the total households in India. 88% of households are below 12 lakhs. The small car market, the entry-level car market, the ability of the 280 million scooter owners to buy a safer, more comfortable transport is ultimately what is going to be the major market for India. 12% Indians cannot make up the market for the country. This bigger segment has to grow at some point. At some point, the government will have to understand that these people are not able to buy cars at this kind of prices. And then I think the whole thing will change. It will come back to what used to be. This market in this segment of SUVs and UVs and things will decline as a percentage because the other market will grow much faster.
All right, but Mr. Bhargava, believe that Suzuki Motor Corporation has scaled back its BEV launch roadmap in India from 6 to 4 by FY30. Is this decision driven by the recent demand slowdown in the EV segment that we are seeing world across?
I think Suzuki has access to all the information from everywhere. And they've been seeing not only global events, but also Indian events. And merely putting a large number of models doesn't increase the sales. You know, it actually adds to cost. The more models you have, the more is the cost. The ideal thing is to have a fewer number of models, but larger sales per model. And I think that is the strategy which Suzuki will also follow, that put excellent models into the market and try and get larger volumes from one model, each model.
All right, understand. Well, Mr. Bhargava, with respect to your new Kharkhoda facility, what number that we have reached in terms of utilization, because it's already been 2 months of commissioning? If you can give us some sense, I know that it's a bit early for you to answer. And along with that, over what timeline do you expect the margins from this plant to actually align with your blended margin profile? I'm not looking for an exact timeline, but just an indication will help.
Well, let me tell you that it takes time for the model first. You know, at the moment, we run only one shift.
Okay.
And many of the equipments are still getting tried out in a sense that they have to see that how they get up to full capacity. We start a second shift in the plant after, I think, 4 or 5 months. I'm not sure exactly. And full capacity of the company can come towards the end of the year, provided there's a demand. When both shifts are running fully. The margins, therefore, you can get from the plant only when the product from that plant is at full capacity. So towards the end of the year would be a better time frame for that, I think.
All right. Mr. Bhargava, along with that, we understand that the automakers recently met in Delhi on the back of the state draft policy, which actually proposes concessions for the hybrids. If you can help us understand that, we know that for now, Maruti Suzuki is the largest player when it comes to hybrid. But what is the rationale for you for such state incentives? How can it actually help the demand for the hybrids, and especially for Maruti Suzuki, given the fact that even you are also preparing for an EV launch?
I think there's a misunderstanding. EVs are not going to become 100% straight away. At the moment, EVs plus hybrids are barely 5% of total sales. 95% are petrol and diesel and CNG. The maximum pollution comes from petrol and diesel. Hybrids and electric cars are cleaner cars. Hybrids are 35% roughly more efficient than petrol and diesel cars. So it's not petrol versus hybrid, hybrid versus electric. It's hybrid and electric versus petrol and diesel, because hybrids and electric vehicles are required to replace petrol and diesel vehicles as quickly as possible. If you could do it with one of them, whichever is the cleaner, well and good. But obviously, each year you can't suddenly jump from 0 to 100. And therefore, you need more cleaner vehicles, which will replace the dirtier vehicles. And the strategy which government is following and promoting hybrids and accepting hybrids is just that you need to reduce carbon emission every year. It's not as if you can go 100% and then suddenly drop to 0. And the accumulated carbon in the atmosphere is the sum of what happens every year. So the strategy is that reduce carbon emission every year, and that you can do by maximizing the sale of cleaner vehicles and reducing the sale of the dirtier vehicles.
All right, point taken. And lastly, Mr. Bhargava, all eyes are definitely on e-Vitara actually coming onto the roads. The launch is already done. But with respect to the pricing, Mr. Bhargava, what strategy will the company adopt? Help us with some understanding on this, because the indicative price band and what the street is anticipating is nearly 17 to 22 lakh rupees, going up to 25 lakhs. So can we assume that the actual number could actually come closer to these assumptions?
I have absolutely no idea.
All right, I was expecting for the same, but just wanted to touch a bit and try my luck there. But thank you so much, Mr. Bhargava, for taking the time out and speaking with us. So good chatting with you.
Thank you.